Welcome back to the MyLatinLife podcast. Since 2014, MyLatinLife has been your trusted guide to traveling and living in Latin America. Our guest today is Francis Corvino from Lygos Finance. Lygos Finance is basically non-custodial Bitcoin lending for institutions and high net worth individuals. This can be an interesting part of your structure, especially for our audience of digital nomads and expats and people who know how to do fun stuff with their tax residency and their personal structure. But yeah, we welcome Francis to the podcast.
It's great to be here. Thank you very much for having me.
Absolutely. Yes, we got introduced by some mutual friends, and they said you got to check out what Lygos is building. And I can definitely see how people are looking for this sort of Bitcoin lending platform, lend against their crypto. And you have 8,000 followers on Twitter. We have a bunch of followers in common, and would love to kind of hear a little bit more about what you're building.
Yeah, absolutely. So to give a little bit of background on myself personally, previous to this job, I was actually working in institutional lending. And I worked in institutional lending sort of like from 2020 through like 2023, 2024. And during that period of time, you had what many call kind of the crypto credit bubble, right? So many folks took out loans via folks like BlockFi, Celsius, Voyager,
Mm-hmm.
Genesis. And what became very obvious to me as someone who had these folks as counterparties is when you post like $1 million or even $100 million as collateral and borrow $50 million. The reality is, you don't actually have a $50 million borrow from that counterparty. You have a $50 million loan to them, which you're paying for, and that becomes excessively clear when these companies start to sort of perform in ways in which they maybe shouldn't be, and declare bankruptcy, as pretty much every single one of the firms, actually every single one of the firms that I just did. So if you had, at $1 million loan and you had $2 million of collateral, all of a sudden you found yourself with $1 million claim against the bankruptcy estate of, these various different platforms. Bitcoin is a particularly challenging asset to avoid this with because it lacks programmability, right? So if we look at what we have in Ethereum, it's very easy. You send your Ethereum over to Aave, you borrow cash against it via a money market. You have a good amount of protocol risk there because you have kind of unbounded Turing complete risk. You can't exhaustively actually happen, but you have a very efficient market and it's pretty easy to go borrow. But that issue still wasn't solved on Bitcoin because at the end of the day, Bitcoin doesn't really have complex computation. So what we worked to do was essentially create a solution to allow people to borrow cash against their Bitcoin on L1 Bitcoin, no wrapping, no staking, no MPC, no trusted execution environment, just pure Bitcoin transactions. The only sort of like drawback to it in comparing it to Ethereum is that it's only for two parties, right? So very similar to a Lightning channel, you have we have sort of a shared ownership over the channel. Um, and only in the event that Bitcoin goes below a certain price will I be able to repossess the collateral. And only in the event that you, as the borrower, repay the loan, will you be able to repossess your own Bitcoin. But what that is really valuable in doing is avoiding situations like sort of the BlockFi because you know that I can't repossess that collateral until Bitcoin goes below a certain price. So you sort of have like a security interest in your own UTXOs and your own Bitcoin, and you know that I can't go and mess around with it so much. And in the event that something bad does happen to our company, you can just repay your loan and force that Bitcoin to go back to you. And there's no way for me to take that Bitcoin unless during that period of time the loan hits liquidation. So we just felt that we could introduce something which was very unique to the market, fully on chain, fully on L1 Bitcoin, that allowed people to borrow cash against their Bitcoin and leverage it for their life or business.
That's good that you're thinking about these things because that's I'm sure super important to people that if the company goes under, it's still covered sort of mathematically. I saw that the big mantra was certainty engineered. Where
Yes.
does that come from?
So it's really important. It's a great question. And I touched on it a little bit briefly, but like when you look at, and this is going to get a little bit technical here, but there's when you have a Turing complete virtual machine, sort of like one of the assumptions there is there's no way to test every potential input against every potential output. So you can't formally verify everything that could potentially happen in your Aave smart contract. At the end of the day, there could always be new exits. we saw Balancer just get hacked, and that was a 2021 OG DeFi protocol which had 10 on. Right? Why can't we know for certain that that's not going to happen again? Well, because we can't actually test every potential outcome of the protocol. Now with Bitcoin, again, you have the downside of it's only two parties, so you can't perform something or create something like a money market, but you can do just enough to do a two-party loan. And because it's just enough, it's so simple. It's not Turing complete that you can actually go on a piece of paper and you can write out everything that could potentially happen with that loan. So our goal at Lygos is to not only balance the credit risk of not allowing your counterparty to just haphazardly do anything with your Bitcoin, but also to manage sort of the protocol risk, right? Like we don't want to have an exploit on our protocol. And it's very, very, very unlikely that we would ever have that kind of exploit on our protocol, simply because we can actually exhaustively test and formally verify every single potential outcome of the, which is not something that you can do in sort of like traditional DeFi when you move away from.
So do you think you could walk us through if someone had, 10 Bitcoin, $1,000,000 basically that they
Mhm.
wanted to lend against? Could you sort of walk us through that transaction?
Yep. So if you want to borrow, right, against your BTC, so you say
Right.
you have 10 BTC, you post $1 million in collateral. So what we're going to do, and again, we'll get a little bit technical here, but I'll try and use some analogies. So a Bitcoin transaction is a bit like a check, right? You write, I am spending this BTC from Francis to Vance, and I own that BTC, and the spending condition of that BTC is my signature, so my private key, right? What we do is we create a 2 of 2. So that means that Vance needs to sign and I also. So without your permission, I can't unilaterally do anything that I want with the Bitcoin. So what's going to happen is we're going to create that 2 of 2 vault, right? You're going to send your Bitcoin there and I'm not going to be able to move it. However, we're also going to take another set of checks, right? And these checks will have an additional spending. I will sign it and you will sign it. So if this was sort of a normal Bitcoin transaction, it would be spendable to wherever right now. But we add sort of the third secret to the check. And that secret is correlated to the price of Bitcoin and reported by a third-party oracle. So you can think, someone like Chainlink. In our case, we use a Magnolia Finance, which is a Draper-backed custodian. But their job is to report the price. And these Bitcoin transactions become valid only when the Bitcoin price breaches a certain threshold and a secret is leaked by the oracle, which can then be used as the final spending condition for those pre-signed trades. So this sounds a bit complicated, but in the end, it's actually very, very simple. Really, what it means is, we create a vault. You move your Bitcoin, your 10 BTC to that vault. I send you, I guess, maybe $500,000, $700,000 of USDC. And then in the event that Bitcoin price goes below a certain level, the oracle will say, hey, Bitcoin price is below that certain level, which gives me the ability to spend the pre-signed transactions and repossess my Bitcoin. And on the other hand, if you repay your loan, you're going to make a USDC transaction to a specific address. The oracle will monitor that address. It will see that the balance of that address has gone above a certain level, allowing us to recognize the fact that the loan has been repaid. And as a result of the loan being repaid, the oracle will again leak a secret, allowing you to take the third and missing spending condition and complete the transaction. Right? So you can now unilaterally take your Bitcoin back from me without my permission. Why? Because you repaid the loan. So yeah, it's all things that can be enforced just on Bitcoin L1, which is really, really nice and beautiful about it.
Mm-hmm.
And it's, again, very, very simple from a protocol risk.
Mm-hmm. Could you explain this oracle again for people who are a bit unfamiliar? And so basically, you're depending on a third party to provide the price feed, and they're sort of involved in the margin call if it ever gets to that.
No, so they're not involved in the margin call. All they're doing is providing a price, right? So if you are borrowing on Aave or wherever you're borrowing, right, it doesn't matter. This is across the board in all sort of DeFi, but someone has to report the price, right? So the way that we report the price is we scrape the price, I believe, from Binance, Coinbase, Kraken, and then we throw out like outlier prices, or that's what sorry, the third party Oracle does. They do. We agreed with them. They'll do Binance, Kraken, I think. I think it's Binance, Kraken, and Coinbase. I'm trying to remember exactly. But
Okay.
they'll take the prices, and then their entire job is they're just reporting price, right? So they report price,
Okay.
they report price, they report price, they report price, they report. when price falls below a certain level, we go and we see, yes, they have in fact reported the price. And then we can use that price that they have reported on our Bitcoin transaction to make it a valid Bitcoin transaction, which can be spent to us. So the Oracle gives us the ability to repossess the
Right.
Bitcoin to a
So it's just a
predefined
stock
value.
ticker, really. It's just a ticker,
Yeah,
and it's sort
yeah,
of
it's
like a
just
composite of different prices. And I know the price can be different in New York compared to, Tokyo or something, but like it can't be too much
exactly.
of a range. Like, it's between probably 1 to 3
Exactly.
percent
And
or something.
we want to be clear about the risks. So like the risk is if we collude with the Oracle, right? So the Oracle's job is just to report price. Like they're a regulated company. If they don't do what
Uh-huh.
they're supposed to do contractually, that's fraud. But hypothetically, we could go to our one Oracle, or maybe we have multiple Oracles, and we could say, hey, if you do this, we'll give you a little bit on this, right? But that's
Right.
not our business. Any
So if they're
potential
only
DeFi
reporting the
applications
price, does the lendee or well, I'm getting my terms ridiculous here, but
borrower.
does the person like can you choose which ticker or which oracle you want to use, or do you always use the same one?
So for now, we just use Magnolia Finance. Like we're still a relatively new company, but down the road we'll be introducing additional oracles, and we would like to give our customers
It's
the
like an
ability.
API call, right?
Yeah,
Okay. And kind of speaking of the technical stuff, and then we can sort of wrap up on technical, and then I have other spicy questions for you. But what has been sort of the biggest technical hurdle you've solved since launch, and what kind of keeps you up at night on the engineering side?
yeah. So to be honest with you, I think we're really good on the engineering front because we were the first people to produce oracles or produce DLCs in the wild. So our company is sort of a combination of two different forces. On one hand, you have Atomic Finance. So it's an old company backed by Initialized who was pre-seeded, I think Instacart and Coinbase. So very traditional, high quality. They were really just focused on executing on the engineering side of things. So they've already built or had already built discrete log contracts for call options when we met. Right? They didn't do a whole lot on the marketing front. They didn't know a whole lot about sort of the financial side of things. But on the engineering front, we have 5 years of experience, $140 million, no bugs, no vulnerabilities, just like kind of perfection. And then on our side of the business, we recognize something that's unique. So I've touched on this a couple times, but like these are only two-party relationships, right? So you can't do, hey, anyone can lend to anyone through this single omnibus vault. It's just essentially a little lightning, a bilateral relationship. Traditionally, bilateral relationships are not stuff that like low-end retail gets involved in because it's just too much hassle, right? You need to sort of have a bespoke relationship with each one of them, and that doesn't scale very well. And what Atomic had been focused on was sort of these sort of like smaller retail relationships. On our end, we were focused at Anchorage Digital. Jay and I, who's the CEO, we were focused on institutional loans, and those are just pure bilateral relationships. So we felt that we could bring in sort of our institutional background and some of
Mhm.
the hunkier, bigger size loans, combine that with the engineering excellence that Atomic Finance had put forward over the last half
Mhm.
decade, and together we could sort of say, okay, these are bilateral contracts. Bilateral is better for bigger. We have great we have a great background in building sort of like big lending desks for institutions, high net worth individuals. You have a great background in developing and engineering sort of
Mhm.
bilateral contracts. If we put those two things together, we might have a lot of success here. So I think the most challenging thing wasn't on the engineering side, and it's not on the finding customer side. It's actually in the recognizing what the product that we have is. The product that we have is a bilateral. We can do whatever you want, but at the end of the day, it's a bilateral product, and bilateral products are better for high net worth individuals and higher touch relationships. So it was more about sort of understanding on the business side what our product was that our engineers were building, and then
Mhm.
tailoring our business approach to what that sort of engineering
Mhm.
was building.
Because I understand you're targeting high net worth individuals as well as institutions.
Mhm.
What kind of lending capacity can you actually do? Like, could you do $100 million loan or
Yeah,
something?
for sure. So like one of the really nice things about having a background in institutional lending and having, between Jay and I think it's like about a decade specifically in cryptocurrency, Bitcoin lending. Like we've been
Hmm.
around, we know these, we know what our companies are. And when we were at Anchorage, we were one of the few lending desks which not only survived but did quite well. Paid back all of our lenders in full, never gypped a single counterparty. no loss of lender capital. So we've built some trust over the years. And we've also been really, really lucky and grateful to have a lot of high net worth individuals. And I'm just going to be honest with this one. There are a lot of people in Bitcoin who made a lot of money in Bitcoin and, frankly speaking, are looking for things to do. So they are really excited to be involved in the company. They've been unbelievable. They've been unbelievable almost as employees to us, but they're also like big lenders on our platform. So through a combination of like traditional brokerages, which we can borrow through, we have good relationships there. And as a result of just being folks who've been in the Bitcoin industry for a long time and have made really strong relationships with people who've invested in the top asset class ever, we have a really good access to capital. Like if we wanted to go turn around at $100 million in a week.
Does that take time to? Yeah, it takes time to syndicate that, sort of.
Yeah, I mean, at 100 million, I think it would probably take us about a week. Like we couldn't
Okay,
fill that
it's not just like a math formula and then the money
No,
appears out
no,
of
no, it's not a
nowhere.
math because it's bilateral, right? Like
Okay.
you come to me, you say you want an $100 million loan. I'm not syndicating you across a protocol of everyone on DeFi who's done it. I'm finding a lender who's willing to fill that, or a couple
Mhm.
lenders who are willing to fill it, in little tranches. But like 100 million is a drop in the bucket, right? There's like we had a $86 million. We missed it. Someone else beat us. Not for terms so much as for like it was a non-lender who beat us with an $86 million loan, which is insane. But yeah, we were able to fill that within like we knew we had the capital to fill it within I think like an hour. So it's not about the capital so much as sometimes you have to compete for loans, and there's some interesting situations out there where you'll get non-lenders but I don't want to get its own rabbit hole of Bitcoin.
No wild collateral stories you can tell us?
Oh, I mean, I have a lot of wild stories, but my favorite would definitely be, I mean, the Three Arrows Capital one for my Anchorage days is probably the best story that I have. We were all really, really excited to work with Three Arrows Capital, get them onboarded. Um, and we did our initial risk call with them. We get on the risk call. They give us a balance sheet which says we have greater than, I think it was like $3 billion at less than like 0.5x leverage. And then it was just signed by their CFO at the bottom. We got off the call. They were asking us for like an uncollateralized loan. And our head of risk at the time, I remember it was very quiet in the call. And he just, what the fuck am I supposed to do with this? But when we didn't lend to them, they told us that we would be sorry. We were the only ones not, yada, yada. Days later, right, like completely out of business. Um, that would be, I mean, that personally is definitely one of my favorite stories. But if you rack my brain hard enough, all of these things started to kind of like blend into each other between like 2023, 2022. There was just so much there was so much moral hazard that like all of these sort of like nasty combinations of things started to like blend into. I don't want to talk, too much smack on any individual group. Three Arrows Capital's fine. What they did was so heinous. But yeah, there was a lot of there was a lot of situations like that. Another one, this is one of my favorites. We gave a guy a margin call. He was at a nightclub in Miami, and he answered. It was a rather large margin call too, and he still found a way to answer the margin call. So there are some good ones as well. But we've called people in pretty much all walks of life, gotten them to top up their loans. We've seen it all.
Okay. And so how do you stack up against other players in this space, right? Like there are other prime brokers or crypto credit companies out there.
Yeah.
How do you?
So I'll go through them. The one that was previously closest to us was a company called Lava. They recently, without actually warning their customers, moved from non-custodial to custodial, which if you look online right now, it's a pretty big controversy. Um, so that's sort of like one category. But in terms of non-custodial lenders on Bitcoin L1, we're in a category by ourselves. We're the only ones doing it. So we don't really have competitors in that capacity. There are still just like traditional competitors that you might have. So, for example, Coinbase will do loans as well through Morpho, but you can't do more than 1 million. With us, as I said, you want to do 100 million, you want to do 5 million, great. There's also, tri-parties. Anchorage has a tri-party where you can borrow through them. But if you're looking to borrow under $25 million, like they're probably not that interested in working with you. Same goes for sort of some of those like top level brokers as well. Additionally, there are competitors like Ledin, who we greatly respect. and think extremely highly of. But the difference between us and them is really just exclusively we don't have custody of the BTC collateral and they do. And you do have to trust them implicitly to some extent. Whereas with us, that's not the case.
Okay, well that's a huge difference, right?
Yep, for sure. For sure. But they've been, well, I will say, they've been good actors. And there's a lot of folks in the space who have been bad actors. So it's also important, I think, to highlight folks who've been good.
And what do you think about retail and how that plays in? Is it just it doesn't make sense with your model, or is that coming in the future?
Well, it's a really, really good question. You don't want to bite off too much at once, right? At the end of the day, whether you're servicing $1 million loan or a $10 loan, it takes kind of the same amount of time to liquidate them. It takes the same amount of time to liquidate them, right? It takes the same amount of time to get into the loan. And whether you're selling to someone like, when someone buys a Toyota Camry versus when they buy a Lamborghini, generally speaking, they're putting in about the same, right? Um, Additionally, there's operational risk in over collateralized lending, right? Like we have to once we repossess the Bitcoin, go and sell it, and we can't make mistakes. We have to be really tactical about doing it. We also have to support our clients, right, and making sure that they're able to top up their loan, making sure that they know they have a margin call. And we want to try and do that to the best of our ability. We believe that when we go sort of down the retail route, it distract or like lower, like under 50K, right? It starts to distract us a little bit. So we want to treat all of our customers equally. But if we have a customer who's borrowing, $100, and we have another customer who's borrowing 100 million, and we're distracted by the $100 loan, that's a bit of an issue, right? We've also built a really good software product, which automates a lot of this stuff, and it's automated it to the point where I think we potentially the software product ended up being better than I expected it could be, to be completely honest with you. So I do think that there's the possibility to go down market to retail eventually. But we're going to start institutional because that's our background, that's our bread and butter. It's what we know how to do, and it's what we feel safest doing. And when we feel safe and we feel that we have, we have everything that we need and more in order to work with retail, we'll consider going down market.
Okay, nice.
But you just don't want to rush into it, right? Like at the end of the day, when there's only a couple really, really big loans, you have more time to think. And sometimes you just need to think and figure out how to solve like a certain situation or just to make sure that you do things efficiently. So until we fully have that down and we've organized everything in such a way that whether we have 500 loans or 5,000 loans, we're able to work with them all in a really, really great way that provides, white glove service to all of them. They all feel comfortable topping up their loans. That's when we'll go down that route.
Okay, fair enough. And what can people kind of expect as an interest rate on one of
Yeah,
these deals? Is it based on the
10%.
10-year or?
No, it's 10%. Like we're pretty negotiable, honestly, in terms of what our tenure is on the loans. We have, again, really, really good lenders who are super excited about the product and excited about people borrowing cash against their Bitcoin custodially. Like it's something that I think they believe in, and they really seem to want their counterparties to get what they want. They're happy, we're lending at 10% right now. And we're very negotiable on tenure. It's just really, so this is what I talked about. Like there's always sort of these like hidden risks in lending, right? One of these risks that I think people don't really appreciate very much is duration risk, right? And this was one of the big things that took down a lot of these funds in 2023. The GBTC trade in the end was sort of an example of a duration risk fail, but we are really careful about managing our duration risk. So if you come to us and say, hey, I wanted $1 million loan, I want it for a year term, I want it for a year and a half term, we're going to go find a lender who is willing to give the capital at a year and a half. We're not going to go borrow open term and then go lend out for a year and a half, right? And again, that's why we're really grateful that we have these great sort of like high net worth individuals and institutions who are flexible with us so that we can provide those terms to our lenders or to our borrowers without having to take on additional risk.
Right. That's called duration risk, I think.
Yeah. I think Warren Buffett said liquor, ladies, and leverage are like the three obvious risks. But like aside from leverage, duration risk and interest rate risk, if you say you're borrowing at 8%, and then the market rate for lending goes down to 2% or something like that, all of a sudden you have 8% liability that you have to pay, and your kind of revenue is only at 2%. So that's one kind of risk that you always need leverage, obviously, you need to manage that. And then duration risk, as I said, if your book has an expiration on average of like 2 years and
Mm-hmm.
everything you borrowed is short-term capital, which can be callable in 20 days,
Mm-hmm.
it's kind of an issue. So we try and look
So
at
it's
managing.
sort of a flat rate. It's not really based on like the Fed's fund rate or anything.
No, I mean, like, to be honest with you, the way that the industry works is it shifts a bit off of like whatever the Fed funds rate is, right? Because the Fed funds rate is like almost a perfect. It's like the companies that do that sort of like SOFR plus 200, right? Something like that. It implies an already really, really sophisticated and advanced market where the money flows in directly, right? Like, SOFR changes, the rates change the next day because there's a different amount of capital in there. Like people are like, oh, I'm getting, an additional 2% because SOFR went, right? I'm
Mm-hmm.
going to go lend them. Whereas in the kind of like Bitcoin over collateralized world, it's like stuff just takes longer. You don't have the depth of market participants that allow you to completely track SOFR as you normally. At the end of the day, it's much more sort of akin to like, who's in the market.
Mm-hmm.
And it will definitely change as a result of SOFR to some extent, but it's definitely going to be much more delayed than like kind of the traditional finance.
Okay. And could you actually help me with the term over collateralized? I don't really
Yes,
know what you mean
for
by
sure.
that.
So essentially, if you're, say you have $100 of collateral or one Bitcoin, 100K,
Uh,
over collateralized just means that the amount of USD that you're borrowing is less than the amount of BTC that you posted as collateral, right? So say you have $1 million of collateral
uh,
and you have a $500,000 loan. If Bitcoin goes down, say like 40, 46, 47%, now you've reached sort of this level
uh,
where we're starting to get to the point where the collateral is less than the value of the outstanding principal on the loan. So when that happens, that's when we'll sell the Bitcoin in order to make sure that our lenders stay whole, right? But before that happens, we're giving you margin calls. We're telling you to add Bitcoin. But it's imperative to us that we constantly stay in a position where the contract, which again, we cannot take that Bitcoin, we can't rehypothecate it, we can't do anything with it. The contract needs to have more collateral value than the outstanding principal on the loan in order to protect ourselves and in order to protect lenders in the platform.
okay. And so does it need to be Bitcoin, or what if it's in the deepest depths of my cold wallet and the government doesn't know about it? How does that work?
Okay, so on the cold wallet side of things, we will be able to allow you to enter a discrete log contract via hardware wallet very shortly. We're pending an announcement on that. So we're really, really excited about that for one. Yeah, I mean, I guess that's how I'd put it. We'll be really excited to be working with hardware wallet shortly. Like we think that's
Okay. I'm sure people will be happy to hear that.
yeah, we like hardware wallets.
How does that work? If you have a hardware wallet with some, 10-year-old Bitcoin that hasn't moved in 10 years, and then you do this over collateralized loan, does that sort of activate that Bitcoin in a way, or like sort
I
of
mean,
put
you
it
got to
on the.
move it, right? You do have to move it on chain for sure because
Mhm.
you're moving it from one set of spending conditions, which is only my key can spend it,
Uh-huh.
to another set of spending conditions, which is only my key can spend it with the lender, right? You're still using the hardware wallet. The Bitcoin will never you still get to use the hardware wallet as your secure signing device. But you do have to make an on-chain Bitcoin transaction because that Bitcoin needs to be encumbered differently now that.
Okay, good to know. And are the exchanges involved in this transaction at all? Like, do you need to have an account with an exchange?
No,
Good. Well, that's helpful because that's another rabbit hole of problems trying to open
for
up
sure,
exchanges sometimes for people.
for sure.
Okay, cool. Um, One other kind of learning questions I had was like, could you explain DLCs a bit? How that like
Yeah. So
what?
DLCs, these are the contracts that we're talking about here, which sort of
Mm,
encumber the Bitcoin. Um, they again, it's really, really just a very simple. You post the Bitcoin in a contract where you have one key, I have one key, and then there is a specific set of events that will allow each one of us individually unilaterally that Bitcoin. I'm able to unilaterally spend the Bitcoin from that discrete log contract when the price of Bitcoin goes below liquidation level. You're able to unilaterally spend that Bitcoin in the event that you repay your. Without those two events, we need to be working together in order to spend the Bitcoin, which is what allows it to stay non-custodial.
Mm. And my understanding is there's sort of different protocols or methods for lending against Bitcoin or borrowing against Bitcoin, of which DLC is just one.
Not really. I mean, unless you want to go centralized, there is not another option. But if you want to go centralized, for sure, there's like you can wrap your Bitcoin, right? But now your Bitcoin is just sitting in, so like that's centralized. Now you can go throw it on Aave. Now you're taking on credit risk from BitGo because they wrapped it, which includes like Justin and Co. And then you're also taking on like significant protocol risk, as we saw from the balancer hack. Again, 2021 OG DeFi protocol, 10 audits still got hacked. Or you can just keep your Bitcoin on L1 Bitcoin, no staking, no wrapping, no bullshit. Your smart contract is infinitely simpler, like literally infinitely simpler than what you'll see on Ethereum, just because, again, something that you could literally write out on a piece of paper to understand every single potential outcome. So again, we really view discrete log contracts as the best balance between the credit risk that you have to take with your counterparty lender and the protocol risk that you have to take with the on mechanism securing your funds. Um, yep.
Okay. And where do you see Bitcoin lending in 5 years from now? Will DLCs still be the standard?
Oh my God, it's a great question. Okay, so we need covenants on Bitcoin at the end of the day, and that's why I think it's harder for us to, because we right now, like, a covenant essentially on Bitcoin is the ability to do more than a two-party contract. Right now we can only do sort of these channel, you and I. But if Bitcoin is able to upgrade at some point, so whether it introduces something like OpCat or whether it introduces, something like CTV, which is a slightly less expressive version, um, either one will allow you to sort of upgrade deals a little bit. But I hate to say it, but I'm not super happy with where Bitcoin development is at right now on either end, right? Like where we have people are yelling about like DSAM on the blockchain camp. And I think the Bitcoin core is a bit distracted from what users want, which is the ability to, have more secure ways to custody their Bitcoin in more complex ways in which to program the Bitcoin in order to be able to use it in a circular economy. So unfortunately, I do think that there's a chance that this is the best way that we will find in order to borrow against your Bitcoin. I really, really, really hope that, not so much from the standpoint of like, it's more about an inclusive standpoint. I think when you can do multi-party contracts with more than two counterparties, you're just going to be able to include a lot more people. So I really, really, really hope that Bitcoin will introduce covenants, because I think it'll allow Bitcoin to be usable for many. One of the things which I'm a little bit disappointed, is, like, again, bilateral contracts generally for larger counterparties, right? And if we are exclusively building Bitcoin for, like, I'm a Bitcoiner at the end of the day, right? I run a company
Mm-hmm.
which does a lot of, but I'm a
Mm-hmm.
Bitcoiner and I care about every single Bitcoin. And right now, Bitcoin does not have the covenant. It doesn't have the technology that it needs in order to suitably serve every single one of those. So I think that this is, for the foreseeable future, the only way to borrow against your Bitcoin. But I would really love to see a more inclusive Bitcoin in the future. And I think that the way to achieve that is by activating.
Okay. And speaking of inclusivity, um, do people have to pass KYC? Do they need to pass an Interpol police check to work with you guys, or does the crypto just sort of speak for itself and it pretty much takes anyone, or is there a human element
It'll,
there?
it'll depend on the situation, right? Like, and it'll depend on the terms of with which the lender that you're working with, right? At the end of the day, Lygos is a platform, right? Through that platform, you can borrow from anyone in the world, right? So it'll really, in the end, come down to sort of the direct relationship with whoever the counterparty is, and that's. But
Okay.
we'll have some
So
updates on
people
that.
know who their counterparty is. They say, "Hey, man, you're lending against a Saudi oil sheik, or how does
Well, it
that
could
work?
be, right? There's sort of different ways that you can do it. Like in some senses, it's like kind of beneficial to have a legal contract sometimes. Just like, I don't know, if they default elsewhere, right? Then maybe I want them to default on this term, and I want to have a legal that says. So sometimes people like legal agreements, right? They want to know who their counterparty is. I respect that. There's also going to be other situations down the line where people just want to lend through this peer-to-peer protocol. They're just using a peer-to-peer protocol. They don't really care who's on the other end. And the crypto can, from a security standpoint, fully speak for itself because it's highly liquid. And
Right,
one Bitcoin is one Bitcoin.
right.
So it's about who's using the protocol and how they're using the protocol.
Okay, so sounds like some flexibility there. Cool, I like it. Dude, thank you for coming on and telling us all about this, because you don't have to do this. Your markets, institutions, high net worth individuals. So hopefully we got some high net worth individuals listening to this, and
I'm
also as
sure
you
you
go more retail.
I mean,
Yeah,
that's the
you'd be
interesting
surprised.
thing,
You'd be
right?
surprised.
Like Bitcoin is the top performing asset class of the last decade plus, right? So if you bought a little bit of Bitcoin in 2020 when it crashed down to 4.2K as a result of like the BitMEX order book rugging us, you're probably a high net worth individual at this point. So we have a lot of high net worth individuals all around us in the Bitcoin industry at this point.
Hmm.
We still feel really bad about those like new folks who are coming into Bitcoin for the first time, trying to stack stats, maybe coming from a society which doesn't have as much wealth in it, and it's hard to serve those customers. But there's plenty of people at this point. Like I think Bitcoiners were like the top donors in the last election or something like that. There's a lot of wealth in the industry
Right.
at this
No, totally,
point. So
totally. Yeah, we
we're
get
happy to
some
serve our high
business.
net worth individual clients. We're glad to serve early adopters. We're proud to serve early adopters. We're also really excited about the activation of Covenant on Bitcoin. Serve all.
What about my Bitcoin Cash? Can I? Do you take Bitcoin
Get the hell
Cash?
out of
Do you
here.
take BCH?
Honestly, no, we won't. I do have a soft spot for Roger Vera because he's a jujitsu guy and he's done some good stuff for the community. But no, we won't be working with Bitcoin Cash. The only, the best collateral in the world is Bitcoin. Bitcoin on the main. If you see a Knots fork, we're gonna be working with the Knots fork. We're on Bitcoin.
Okay, just thought I'd check.
Yeah.
Cool. Well, what kind of final message would you like to get out to the audience?
I guess I'll run with two. One is trust has been violated in this industry so many times that if you're borrowing a significant sum of capital, there is no excuse not to discrete log contract. It is simply the safest way to borrow. Um, and I think that we should really limit the trust that we're putting in counterparties because at this point, we frankly don't need. Discrete log contracts are here. You can do bilateral lending. They're extremely secure. And I think that that's the right path forward. The second thing that I want to leave everyone with, and again, this is sort of not so much part of my, but like I believe it's really important that Bitcoin activates covenant. That I hope that this community and all of the communities who work with Bitcoin will recognize that part of the original of Bitcoin is to serve every single user, and until we have covenants, we don't feel that we can do that. So I love to see people who are ardently supportive of.
Okay, and I know we're kind of in outro stage, but real quick, I don't know about this covenant thing. Is this something that's going to become native to Bitcoin, or how does that work?
Yeah. So again, a covenant is the ability to have multi-party contracts on Bitcoin. Right now, you can do a channel. So I can have a contract with you as a discrete log contract. It's just you and I. But the
Hmm.
second that we want to add a third, a fourth, a fifth person, and the second that we want to try and dynamically leave and come back to this sort of agreement over how we spend and what the rules are over this specific subset of coins, we need to activate these things called covenants. OpCat being one of them. Um, CTV being another one predominantly. And once those get activated, you will be able to have more than just bilateral people. You'll be able to have multi-party contracts where in the case of CAT, people can dynamically leave and not leave. And they can't dynamically leave and not leave, but at least you can, many different parties in there. And it's just really, really hard to serve lower, uh, dollar basis or Bitcoin basis users through bilateral contracts because bilateral contracts simply just take a little bit more. So Covenants, again, just give us that ability to bring multiple different people into the contracts, not just two, as many as we want, which allows us to sort of share costs, share resources, pool capital, and just provide like a really good experience for any Bitcoin.
Okay, cool. Yeah, thanks for all the learnings here, man. You definitely explained some good concepts in a very, easy to understand way.
Well, I appreciate that. I love Bitcoin, so I've been doing this, as I said, like literally since my high school dorm days. Now a long time ago. So hopefully I'm pretty practiced at it.
Last year.
No. High school farm. Long time ago. More than 10 years.
You guys can't see Francis, but he's actually 19.
I wish.
We're recording audio only, by the way. I forgot to
Oh,
mention.
okay. Then I wish I knew that ahead of time because I did a lot of fluffing.
They can't see the lovely beard.
Uh-huh.
No, but dude, thank you so much for joining us. It was really educational. Where can people find more about you? Of course, we're going to put a link in the description to the website. I saw your Twitter's a little bit inactive. You should get back on it, at least on your personal one.
Oh, my personal. Wait, no, I think you might have found the wrong personal Twitter. That is an old personal.
Some other
Twitter.
dude with the same name.
So now I've kind of doxed myself. I was previously in an anon on Twitter. I'm Hobart, which is Stark and Lime. And then for Lygos, we're at Lygos Finance. And then for our website, lygos.finance.
That's it. Lygos.finance. And I'll put the Lygos Finance Twitter in the description because, Twitter's where a lot of our audience is. So awesome. They'll be happy to connect with you there. Yeah.
Follow Stark and Lime for hot takes on cooking, Bitcoin, and wrestling.
Do you want to spell it? I don't know.
StarkAndLime. But if you just look up Hobart, I'm pretty sure it'll show up. Okay,
now I'm curious. I didn't know about the alt, but I guess everyone.
Yeah, the alt just became no longer. It stopped being an alt.
Okay, cool.
Production on mainnet.
Well, you might double your followers. Who knows? Cool. Well, this has been another episode of the MyLatinLife podcast. Again, our guest today, Francis Corvino from Lygos Finance. Thanks again to Francis for joining us, and thank you to the audience for listening. Please be sure to subscribe to the podcast, follow the podcast on Spotify, Apple Podcasts, wherever you listen to podcasts. We put out 2 episodes a week with amazing guests like Francis, and you won't want to miss an episode. Ciao for now.
Cheers.